Oh, that you're already done with that.
Okay,
I know you have to do it.
so I figure I can do a couple different things in the hour and a half we've got here. One, I can answer questions. This is, by the way, not your final. This is Spring 01 JBLM's final. I can walk you through a JBLM final.
Yes.
Your final will be similar, but not the same. I can answer questions. I can do whatever you'd like within reason for the next hour and a half or so.
Walk us through a similar example.
Is that a consensus? Walk through a similar exam?
We don't
And
need
just a weighted average.
Yeah,
A weighted average cost of capital and a capital budgeting problem. Okay.
You can skip the multiple.
Yeah, you can, yeah.
We'll do the
That's
multiple
good.
choice if we have time.
We'll skip the multiple choice because they didn't get any multiple choice on their final. They got 5 problems instead of 2, so, and no multiple choice.
Can we get like scrap the multiple choice and get like,
You get 5 problems?
no, just like 3
Oh,
problems.
no.
Just give it-
Okay, so let me walk you through this final. I'll walk you through we'll solve it together. The computer up here is not working. What I wanted to do was split the screens and have one of the screens with the computer kind of with the reference material. The other computer having the spreadsheet, but we'll just go back and forth. How many of you, and be honest, how many of you have prepared the template spreadsheets to go into tomorrow? About half. I'm going to tell you right now that if you haven't, you're me tomorrow. So if you've got them built, or you've at least got a template of a template built, you stand a fighting chance. You're going to be fine. As a matter of fact, I had one of the students who had conflict on tomorrow's that has already taken their final. They finished with 20 minutes left to spare, and they did really well. So it's not an improbable or impossible task. However, they had built out their templates. So it was the same final that you're getting, or very, very similar final to what you're getting tomorrow. So build out those templates. We're going to walk through on my templates the build out today. You may want to take some time as we're going through it to have Excel pulled up on your screen to make sure you can save it off to your drive or to your Google Drive or to somewhere, and at least start getting some of the concepts down, because what you're going to see is kind of the model answer for what the template should look like. And if you use the exact template that I'm going to show tonight, you'd probably get 85 to 90% of the way there, and the problem would take you about 5 minutes. So we're going to walk through problem 1, which is a weighted average cost of capital problem. Problem 2, which is a capital budgeting problem. Any questions on?
Which one did you say that we need to do first to lead us into?
You need to do the weighted average cost of capital first.
So the way you're showing it.
Yep, the way I'm showing it. So here's a final exam from Spring 01. Directions are going to look very similar. Show your work for full credit. You may answer the questions in any order, but please label each problem clearly. I'm going to tell you that you're going to do best by answering them in the order given. Problem 1, problem 2. Answer the multiple choices first. They're relatively easy. You should be able to build some confidence, and may also trigger an answer once you get into here. Work on the paper provided, which is going to be a packet that looks something like this. Actually, this is the packet for tomorrow. No. So it's going to look like this. And what you're going to have tomorrow, in case you want a little bit of a heads up, is the 2017 Boeing annual report excerpts. The test or the annual report? The annual report, you'll have a link. You can Google it. I can send it to you, but the parts that you need, instead of 108 pages, the parts that you need, because we don't have a lot of time for the final, I photocopied, and you will have extracted for you. So there's about, instead of 108 pages, you have about 8 pages of the Boeing annual report, so you can find the stuff. And then the rest of it, of course, you got your multiple choices, and you've got a problem set, which looks remarkably like this problem set, with similar directions. So for most questions, for this one, we use the 2015 PACCAR annual report, which may be found here. So in this particular case, I'm going to go ahead and open that up now. Please put your final answers in a box. So when you turn in your paper, put your final answer in a box. When you do it on the Excel spreadsheet, put your final answer in the box. It makes it easier for me to find. And the easier it is for your graders to find, and the easier it is for your graders to read, the better the chances are that you'll get a good grade. So question 1, 30 points. In order to analyze several potential investments in and by PACCAR, several pieces of critical information are required. Use the PACCAR annual report and find, if given, or calculate. What is the effective tax rate for PACCAR in 2015? So here's what I did. I built out a spreadsheet which starts answering all the questions that I have on here. So question 1.1 is, what's the effective tax rate for PACCAR for 2015? How do you think I would go about finding the effective tax rate for PACCAR in 2015?
Determining what the net is.
So there's 2 ways to do it. There's the easy way and there's the hard way. I'm going to show you the easy way. So we're going to open this with Acrobat Reader. And Acrobat Reader has some neat features. These annual reports, just like the Boeing annual report, to which you'll be given a link tomorrow, have they're XML and they have a search feature. Yes, sir.
The annual report, like we're not gonna have like a hard copy of it. We're gonna have
You'll have a hard copy, and you can, since you'll have your computers, you can also go ahead and Google it or link to it and bring it up. But you'll have a hard copy of the sheets of the pages you need.
But we could literally look at hard copy and
Yep.
try to find it.
Yep, and it's in there. However, if you don't want to do that, you can go to this little nifty search feature and look for effective tax rate. And there we go. So in this particular case, the effective tax rate in 2015 was what? 31.4%. So I go over to my spreadsheet and you can see that I've got in there 31.4%, 31.44%. I'm going to put it in the box. There you go. There's 2 points. Assuming a beta for PACCAR of 1.2, a risk-free rate of 3, and a market rate of 9%, calculate the required equity rate of return on PACCAR. So what equation is this? When you see, assuming a beta of X, a risk-free rate and a market rate, what equation is that? Which is measured by, on the equity side, measured by what? When you see beta, what should you think? Risk. When you
Market risk. Market rate of return.
the market's 1, we're getting to that. That's actually your answer to number 2. This is your capital asset pricing model. Now here's what you need to think about for tomorrow. You get into a test tomorrow and you're like, you freeze up, right? You go, oh my God, what the hell is he asking for? There's a beta, there's a market rate of return, there's a risk-free rate, there's a calculated required equity rate. What do I do? If you've got a couple keywords, what should you do? Google it. Because especially if you start getting kind of nervous on the test, Google it. When you can't, if you kind of forget an equation, Google it. If you run into a situation where you're on a multiple choice, you're like, I don't know what the heck that word means. What should you do? Google it. You've got open book, open notes, open computer. Take advantage of it. You're not going to be able to finish if you have to Google everything. But if you've got these templates built and you get something that snags you, Google it. In this particular case, if you Google beta, risk-free, and market rate, it's going to come up with capital asset pricing model. And you're going to go, oh my God, it's a capital asset pricing model. So I got to come up with a required equity rate of return for PACCAR. So required equity rate of return, amazingly, I built in my template this thing that says required return equals risk-free rate plus beta times the market rate minus the risk-free rate. It's so tiny. So let's see. The beta is what? 1.2. And then let's see, what else is it giving me? It says the risk-free rate is 3. So what's the risk-free rate? 3%. And the market rate is 9%. What's the required equity rate of return for PACCAR? 10.2%. Because this required rate of return equals risk-free rate plus beta times the market rate minus risk-free rate is sitting in this box. So if I go to that box, I hit F2. You can see what that equation looks like. So now, I've answered number 2.1. What's required equity rate of return for PACCAR? Is this required rate of return higher or lower than the equity market as a whole? Why? Let's go back to the answer. Required rate of return is 10.2. Is that higher or lower than the equity market as a whole? Why? Yeah, so there's two ways you can answer this question. Both are right. There's one that I like, and there's one that's kind of obvious. The obvious one is required rate of return, 10.2. Is that higher or lower than the market rate? Higher. Why? Because 10.2 is higher than 9. So that's not that hard. Or you could answer it the way I like, which is, well, because the beta is greater than 1. So if the beta is 1, the market rate, it's equal to the market rate. If the beta is greater than 1, it's greater than the market rate. And if it's beta is less than 1, it's less than the market rate. So the answer I've got in here is it's greater because the beta is greater than 1. And I put a box around it because I could find it. But this isn't, so now we're 5 points in, 7 points in if you count the first two for the effective tax rate. Remember I told you that my lowest grade on this particular exam was a 24 out of 100. You are now 7 points into it. This ain't that hard. Just walk through it. What happens is people get nervous because they look at this giant list and they go, oh my God, I'll never figure it out. They don't have a template, so they get in there and they're like, they freeze. If you don't have a template, you're going to freeze. If you have a template, you just plug and chug. So what's the next question? Number 3.
Is the total stockholders' equity at PACCAR?
So what's the total stockholders' equity at PACCAR at the end of 2015? Where would you go to find this information? The financial statements.
Search it.
Search it. Okay, let's search it. Oh, that's bad. Holy crap, there it is. Stockholders' equity. Liabilities and stockholders' equity. So what's the total stockholders' equity at the end of 2015? 6940.4. Total stockholders' equity at the end of 2015, 6940.4. 6940.4. Holy crap, there's 2 more points. So again, you're chunking right through this thing. To compute weighted average cost of capital, you need to know the capital structure and the cost. So what do we now have? You have the equity amount and how much, and do you have the equity cost? Yes, you have the equity cost. Because you answered the required rate of return on equity, which is the cost of equity, and you've got the amount of equity. So you've got the 2 pieces you need for the equity piece. So all we're doing is kind of chunking right through, going, let's get all the data we need for which you're getting partial credit. Here's all the data I need to calculate this thing. I will not leave you out with a calculate the weighted average cost of capital for Boeing and hand you the financial statements and tell you to hand it back to me. I'm going to walk you through each of the steps. You need to find it. You need to understand how this stuff works, but it's not going to be that difficult. So what's the total stockholders' equity of PACCAR at the end of 2015? The total stockholders' equity of PACCAR at the end of 2015 is 6940.4. That's $6,940,400,000. And that goes in right here, nicely labeled total stockholders' equity, bang. So the next question. How much preferred stock is issued and outstanding at the end of 2015? Where are we going to find that? Financial statements.
It's right there.
So how much is issued and outstanding?
Issued,
Preferred stock.
authorized, but none are issued.
None.
0.
So what's your answer?
0.
0.
42.
Total preferred stock, 0. Put a box around it. What is the required rate of return on the outstanding preferred stock?
0.
0. Why?
There is none.
Because there is none. Hard, huh? There's another point.
How much do you worth? So much more.
Well, it wouldn't be hard if you didn't know it.
It's kind of a trick question. I had a lot of people not get it. It's like, well, there's got to be 1.2 million of those. So, because it says that's what's authorized. All right. So now we're coming up with the live. So now we've got the common equity, preferred equity. What's left is
Be dead.
the debt for weighted average cost of capital. If you got common equity, preferred equity, the last thing is the debt. So now we're going to go, okay, what's the debt? So let's walk through it. Adding the truck, parts, and other to the financial services liabilities. Oh no, segment reporting. At the end of 2015, what are PACCAR's balances of? 5 points. 1, 2, 3, 4, 5. So there's 5, 1 point apiece. So adding the 2 together, what's the balance of accounts payable, accrued expenses, and other? Where are we going to find this? The financial statements. So we go back to the financial statements. So you'll notice when I asked the question, when I went over to the spreadsheet, I then wrote down what I needed. And then I said, okay, let me make a box for each one of those. Because it just makes it that much easier. So that way I'm not flipping between 3 things. I'm only flipping between 2 things. So accounts payable, accrued expenses, and other. So what's the amount of, and it says add these 2 together, truck parts and other, and financial services. So we have to add together accounts payable, accrued expenses, and other of 2071.7. And 356.9.
Can you show straight up?
Yep.
When it's represented as like in millions
Yeah, or billions.
or billions.
Yes.
You just want us to just list it off for the amount of numbers that it adds in there,
Yeah, or write 2.456 billion.
and then just.
Yeah, which is fine. So the question was, where did I get those numbers? The first one was accounts payable, accrued expenses, and other for truck parts and other. So there's 2,071,000,000 and 700,000. And then the other was accounts payable, accrued expenses, and other 356.9. So I gave pretty explicit instructions back here that said, adding truck parts and other to financial services liabilities at the end of 2015, what are the balances of? So the balances of are just adding those two together. And I did that in the Excel spreadsheet. So that way, in the event you pick up the wrong number, I could go back and get partial credit. You might get half a point. You might get a quarter of a point. You might get nothing if you don't know what accounts payable, accrued expenses, and other are. But if you make a transposition, you typo something, that's fine. I'm going to show you a couple tricks to make sure you don't. So the next one is residual value guarantees and deferred revenue. So I go back here and I go, okay, residual value guarantees and deferred revenue. There's 1,047,400,000. So 1047.4 plus. And I don't have anything in the financial services revenue for deferred taxes, residual value guarantees, deferred revenue, and other liabilities. So 720.2. Nope. So other belongs up here. Other liabilities, including deferred taxes and dividends payable. So I've got deferred taxes and dividends payable. Dividend payable at the top of 492.6.
Didn't you just add that other liabilities into the top one?
Yeah.
Yeah.
You get that number for the top.
But it should be in that other one, not this, the 720 shouldn't be in that equation. It's the third one.
Other liabilities, including deferred taxes and dividends payable. So dividends payable, 492.6. And deferred taxes and other liabilities of 889.1. And then I've got the next one is, if I go over here, oops. Commercial paper and bank loans. So commercial paper and bank loans appears once, 57.95. And then the last one is term notes. Oops. God, I'm 2796.5. So you can now see that I've answered 5, 1, 2, 3, 4, and 5 by putting them in each of the boxes and adding them up. And then this comes to, I totaled it at 14,169.40. And if I want to check it, I can go over here. I can go, okay, the total truck parts and other liabilities, 4,331.9 plus 9837.5, 14,169.4, 14,169.4. So I know I've got everything. So if I'd misclassified something, you might end up with something in the wrong bucket, but you're going to end up with the right total. So now we've got the amount of debt. We've got, yes.
So, you're telling us that we want to have this workbook outline, right?
Yep.
But are we going to be getting all of these questions? Because I thought you wanted us to focus specifically on the weighted average cost of capital and capital budget. So,
Correct.
do you want us just to make an outline for those two specific things, or for all of this?
Well, in order to calculate weighted average cost of capital, you need all this stuff.
Okay. Okay.
So these are all just, we're about to do the weighted average cost of capital piece. These are just the data points that you need to be able to calculate it.
Okay.
So the short answer is yes, both.
Okay.
But you're going to need to be able to add all this stuff together first. And I'll walk it, and it'll all, I think, become more clear, Kelly, is in like 30 seconds.
Okay.
And the line accrued expenses and other, what's that first word? Before the.
AP, accounts payable.
Oh.
So using the following data and the answers to 1 through 5 above, compute the weighted average cost of capital for PACCAR to the nearest 0.1%. And here's your givens. The pre-tax cost of all liabilities in 5, except for commercial paper and bank loans and term notes, is 0. So cost 0, 0, 0, 0, 0. 0, 0, 0. So I said, okay, AP accrued expenses and other is 0. Residual value guarantees deferred revenue is 0. Other liabilities is 0. Then it says the pre-tax cost for 5.4, which is commercial paper and bank loans, is 1%. So I put in 1%. And then the next given is, oops, the pre-tax cost of 5.5, the term notes, is 1.5%. So I'm going to put 1.5% in here. So you can see I've started building out the cost of debt. You've got a weighted average cost of debt. You've got a cost of 0 for this, 0 for this, 0 for this, 1% for this, 1.5% for this. This is all given.
So those percentages are the tax rate or the cost?
That's the cost. That's the interest rate.
Cost of debt?
Yep. So here's a key component. Remember, debt interest rate or interest expense is tax deductible. So when we're calculating the cost of debt, we want the after-tax cost, not the before-tax cost. So what I've done is I've brought down and linked the tax rate that we found up here in number 1. Up here we've got the tax rate, right? That was the first question we got asked. What's the tax rate? I said, okay, link it. Link it, link it, link it, link it. And then I want the after-tax cost of debt, which is nothing more than the before-tax cost of debt times 1 minus the tax rate. So I'm kind of showing my work here, right? I'm saying, okay, I know that this is my debt. This is the amount. This is the cost, and I know the cost because it was given to me in the problem. Then I go, what's the tax rate? Well, tax rate, I need after-tax cost of debt, so the tax rate was the answer to question number 1. you won't have a question that's being asked of you that is really completely useless. So I'm not just going to ask you the tax rate to see if you can look up the tax rate. You're probably going to have to use it for something. Or in this particular case, potentially multiple somethings. And so you go, okay, what's my after-tax cost of debt? Well, it's 1 minus the tax rate. So I'm going to take the effective, or the cost, the interest rate, I'm going to go down to one that has one. I'm going to take the cost times 1 minus the tax rate. So the effective after-tax cost of debt on a term notes is 1.03%. The effective after-tax cost of debt on the commercial paper is 0.69%. And the effective after-tax cost of debt on all the other receivables is what? Or all the other payables is what?
Say that again.
The effective after-tax cost of debt on the first three categories of payables is zero. So now, this is the one curveball in this question, because it's reality, that you don't tend to see in the book. So what the book has done is essentially said, here's your weighted average cost of debt, and you just get one number, 14,169 at 0.56%. Here, you're calculating that out. So you've got a weighting. Essentially, you've got a weighted average cost of debt. We call this a WACD, weighted average cost of debt. You say, okay, I've got a total of $14,169,400,000 of debt. What's the weighting of each one of these categories? If you can't calculate weighted average, it's going to be tough to calculate weighted average cost of capital. Your weighted average is your total here of the category divided by the total of the whole. So if you got $14,169,400,000 worth of debt and $2,428,000 of it, or $428 million of it is accounts payable. Accounts payable is 17.14% of your debt. And you can see how that equation works. The sum total of all your weighting should equal 100, because this is the percent of the whole, right? So your total should equal 100%. Check your weightings and make sure that your total weighting equals 100%. If it doesn't, you've made a mistake. To get your weighted average cost of debt, all you do is multiply the after-tax cost of debt times its weight. And you're going to do the same thing for weighted average cost of capital, but we're not there yet. So it's the after-tax cost of debt times the weight gives you your weighted average cost of debt. In this particular case, you then sum up all the weighted average cost of debt, and the total weighted average cost of debt for PACCAR is what? 0.56%. So if any of you don't think that debt, it can be really cheap if you're a highly creditworthy company, this is proof of it. These numbers aren't too far off the reality. I made a little bit of a tweak and an adjustment. 0.56%. What questions do you have on weighted average cost of debt? None. So now we have weighted average cost of capital. For those of you who suffered through office hours, remember I told you to build it out so that it includes preferred stock, even though there's no preferred stock in this scenario, because I've walked some folks through this scenario, similar scenarios. Because you never know if you're going to have preferred stock. But you do know that you've got equity, debt, and preferred stock is your capital stack generally. And so in this particular case, you now have all the pieces that you need to be able to answer the question, what's the weighted average cost of capital for PACCAR? You've got equity. So you've got the amount, which is linked back here. You've got the weighting, which is a calculation, and I'll show you. These are all formulas. So you've got that is linked to the answer to 1.3, which is why when you're answering this problem tomorrow, and tomorrow's problem looks very similar, I would put it all on a spreadsheet, link the stuff together, make your life easy. So you can see the equities linked. The weighting is a calculation. It's the same way as we calculated up here. It's calculated down here. You got your total of equity divided by the total in the capital stack, and the next one would be debt, and the sum total of these two should equal 100. You can see what that looks like. See what that looks like. You'll notice that, yes, sir. Yep. So the 10.2 here, these are linked back. So this is linked to E9, the required rate of return on equity, which was your answer to 1.2.1. This is linked back to L22, which in this case was your weighted average cost of debt. Then these get multiplied across. So you multiply the cost times the weighting to get that weighted average cost of capital for that particular piece of the stack. Whoa.
Could you show the cost equation?
Sure. So this goes back to E9. And if you go back to E9 up here, that's that. Let me shrink this a little bit. So you can see when you're building out this weighted average cost of capital, your required rate of return up here is going to equal your equity cost down here. Your weighted average cost of debt here is going to equal your cost of debt here. Your total here is going to be your total here. Your total here is going to be your total here. So the weighted average cost of debt for or the weighted average cost of capital for PACCAR is what? Okay.
1,737. Yeah.
Yes, ma'am.
I have another question. So if the cost is related back to E9, why is it different for the debts? Is that a different equation? Why is it 0.56?
So you've got two. So for cost of capital, you got two pieces. You got your debt cost, which is calculated, which is actually L22, which goes to here.
Oh, okay.
You got your equity cost, and then you've got your debt cost, and that's where these two numbers come from. What other questions do you have on weighted average cost of capital?
What is like the adjustment? Compare that to that one.
Adjustment.
Yeah.
Which
I
adjustment?
saw one like outline that had like a section that said adjustment.
You won't have it here. What other questions, weighted average cost of capital related? If you could do this one question, and this were the JBLM final, you're at a C-.
Yo, that's better than like,
Based on the curve.
that's better than all those people that got 24s.
Yeah, because you got 30 points already.
Yeah.
Yes, sir.
How much is this one worth on ours?
Say again?
How much is like this?
How much is this on yours?
30 points.
30 points
Out of 100.
out of 100. Yes, sir.
How did you get preferred stock?
So we said, okay, how much preferred stock is there?
There's 0.
So we went to you look at the financial statements and it's right here. The financial statements are your friend. And so the one thing that I'd like folks to kind of get at least familiarized with, if not comfortable with, is looking at real financial statements. Because the information, it looks complex, it's really relatively straightforward. You can find the information relatively easily, and the more you practice on real financial statements, the better off you're going to be.
We've had our shares, right?
The preferred stock's right there. If in doubt, when you Google tomorrow, Boeing 2017 annual report, you can search for everything to your heart's content. But I'm here to tell you that the 8 or 9 pages you need will have been printed off and handed to you, including a balance sheet. What other questions on weighted average cost of capital before we shift over to capital budgeting? Okay. So let's talk about capital budgeting. And on this one, there was a extra credit question, which is where can you find the real answers to pre-tax cost of commercial paper and bank loans and term notes, and what are the actual values? In that particular case, you just Google it, or you search it on the PDF, and it'll tell you it's on page, I think, 69, and it was 1.2% and 1.5%. So that's your answer, is two extra credit points. You guys do not have, I believe, I did not leave in that extra credit question. Instead, you have a 10-point extra credit question, which I will give you a heads up on because you can prepare for that in the event that you're not quite comfortable on some of the other stuff. So question two. Question two in this particular case was worth 25 points. For you guys, it's worth 30 points. Yours is a little bit different, but similar things will kind of hold. So PACCAR is considering 2 projects: a new fuel-efficient big flipping truck for foreign markets and a new self-driving huge flipping truck for the U.S. market. So you've got 2 projects. You got BFT and HFT. So there's 2 ways to go about this if you're building out a capital budgeting problem. You can build out a capital budgeting worksheet, which is what I would do. And then you can copy it over. And so you can do all the capital budgeting stuff for HFT, and then you can do all the capital budgeting stuff for BFT and compare the 2. Or you can put them all on one spreadsheet. In this particular case, I put them all on one spreadsheet because it happens to be my answer key. However, you'll get the same answer if you did them separately. So I'm going to walk you through them on the same answer sheet or on the same worksheet. But if you get just one, you can do it just one as well. So the expected net cash flows. So pay attention to some of the wording. If you see net cash flows, what does that mean to you? Above 0. Except they're not above 0. Net cash flows.
So, how much at the end of this are you ahead?
Money you're getting, the money you're going out. Where the cash is flowing.
Yeah, so you got to, so there's going to be 2 types of capital budget problems. You have to figure out which one you're going to get tomorrow. There's one that'll say net cash flow.
Oh.
Net cash flow means that's the cash. It is what it is. This is the cash flow. Bang, 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 bang. There's others that will say, here's the income.
Oh.
Here's the depreciation. Here's the taxes. Here's the X, Y, or Z. And you need to go, okay, let me factor in taxes and let me factor in depreciation. Those are gonna be your two big ones.
This is our economic value,
Not quite,
not yet.
not yet, not quite. You're not gonna even see an economic value added here on either problem, regardless which one you get. If you see net cash flow, you don't need to worry about taxes. You don't need to worry about depreciation. If you see a problem tomorrow that says using the effective tax rate or given the following depreciation table, that should trigger to you that you need to factor in depreciation and taxes. As a matter of fact, what you will find is perhaps your instructor will tell you, please don't forget to factor in depreciation and taxes. So how do I do that?
So how do we do that?
So how do you do that? We'll walk through HFT and BFT, and then I'll show you what the difference would be for depreciation and taxes, because it's basically the same. So let's see. Using the answer to question 1, part 6 above. Oh crap, what's question 1, part 6? Question 1, part 6 was, what's the weighted average cost of capital? Nope. 3.73%. For project BFT, compute NPV, IRR, modified internal rate of return, and payback. Okay. So let's go over to my capital budgeting tab. If I go using the information from that last sheet, the easy way to do this, by the way, is you just go equals, go over here and go equals this. So there's the discount rate that I need. And now I'm going to look at cash flow. So I was given the cash flow, year 0, net cash flow, year 1, year 2, year 3. So negative 55,000. $15,000, $22,000, $35,000. So you can see two things. One is I took the chart and I just laid it out here. And then I did two other pieces. Piece number 1 is I built this out so it says VFD and it's got year 0 through 3. And you see initial cash flow, operating cash flow, terminal cash flow. Initial cash flow is the cash flow from which period? 0. Terminal cash flow is from which period? The last one. So you might get a problem that has 10 periods. All you're going to do is remember that your initial cash flow is your period 0 cash flow. Your terminal cash flow is your last period cash flow. And your operating cash flows are the cash flows in between. And so I built out this little thing that basically just links together the initial cash flow, so where it says year 0, the operating cash flow, terminal cash flow, and then I took the total. The total here is just the sum of, yep. Yes, ma'am. Yes, getting there.
Okay.
So I built this out because Excel likes, for capital budgeting problems, Excel likes stuff this way. It likes stuff kind of running out that way as opposed to running down. It'll work both ways. It likes it better that way. So I took the chart that I gave you and got it, made it horizontal and put in the 3 pieces: initial, operating, and terminal. If we had to figure out taxes, so if it said the pre-tax savings from Project BFD, or the pre-tax earnings from Project BFD in period 1 were $15,000. What's the after-tax earnings?
This is the one that's being read.
Let's say I need to figure out what the after-tax earnings are. Let's say this isn't gross cash flow, this is net cash flow. Or this isn't net cash flow, it's gross cash flow. And we need to figure out what after-tax are. So we've got to factor in taxes. The first thing I'm going to do is go back to my last sheet and pull out my effective tax rate. I'm just going to go over here, go up to number 1, and hit my effective tax rate. So now I got to pay taxes on my earnings. So it's relatively straightforward. I go, okay, what's my taxes? Well, it's a negative number. So it's minus my earnings in period 1 times the tax rate. This is going to be minus my earnings in period 2 times the tax rate. And this is going to be minus my earnings in period 3 times the tax rate. So if you have something that says you need to factor in taxes, all you do, if you built this the way I showed you, is the sum will come up and it'll go, okay, it takes taxes out because you multiplied this by the tax rate, which you brought over from the last sheet, to get your total cash flow, because that's the money that's got to go out to the IRS. You made $15,000, you got to pay $47.10 in taxes, so your net cash flow is $10,290.
Say it again, what it would be like, where is that if you would have to solve for taxes or something, instead of just like, instead of it saying net cash flow, what would it say?
Yeah, let me read to you what it might say. It might say something like this. Using Boeing's marginal tax rate from question 1, part 1 above, what are the initial, annual supplemental, and terminal cash flows? Do not forget tax impacts attributed to the machine for each of the next 4 years.
So you don't do it period 0, you don't have internal that,
That's correct.
only have positive numbers.
No, only on operating numbers and your terminal number. Yes, sir.
Do you press F2 on the MPP?
Yes. Yes, ma'am.
So if you're doing 0, 1, 2, 3, is that considered 4 years right there?
In this particular case, no, it was a 3-year.
Year. So if you were doing 4, 5, or 6 years, then you would go ahead.
You just stretch them out. Yep, stretch it out. So you can see in this particular case, it says there's only 3 years. And so the next question is, okay, now that I've calculated I've kind of built this thing out, what's my MPV? So the MPV is the equation equals MPV. And if you use the formula bar, it's easier to do. So formula, financial, net present value. So you go, okay, what's the rate? 3.73. The required rate of return is equal to 3.73. So I'm just going to link that. And what are the values? It's the three totals of the years. And then you, oops. And then you have to add period 0. Excel always assumes that, it doesn't know that this is period 0. It recognizes it as the first period. And it assumes the cash flows all show up at the end of the period. It's just the way Excel works. So you do periods 1, 2, and 3. This is year 1 through 3, and then you have to add the present value of year 0, which is equal to the amount. There's no discount because it's in year 0. So you have to put plus J8 in this particular case. So that's your net present value equation. Yes, ma'am. Yes. It would be.
So, where,
Yes.
so we would not take this job.
If there were taxes, if it weren't the net cash flow, yeah, I got rid of the taxes up here. See, I took the taxes out. But yes, if you had the taxes, you would just add those in, and you would use the same total. You would use the same formula here as well. So plus period 0. Yes, sir.
That's like a couple going off.
It's bad. It's awful. It's terrible. Now, as long as your formula is right, because what you may have done is not link this and link this back to the last sheet. And so if you rounded it, it's going to be a couple bucks off. And I'm not going to knock points off for that.
Yeah.
So that's NPV. NPV is pretty straightforward. IRR is even more straightforward. The whole thing for IRR. NPV, remember, is period 1 through X plus period 0. IRR is the whole thing. Modified internal rate of return is the whole thing. And your reinvest rate is your required rate of return. The difference, recall, in the difference between modified internal rate of return and internal rate of return is for IRR, we assume that the money coming off of this is reinvested at the IRR rate. For modified internal rate of return, we assume it's reinvested at the required rate of return. So when you see, and you will, regardless of which version of the test you get, when you see modified internal rate of return, remember you need to use the required rate of return to calculate it. So don't forget it. And then payback. How would you approach a payback problem?
Start with the first year.
Start with the first year.
0.
Okay.
Add second.
Add year 1. Add year 1. Now what?
Add second.
Oh. Now what? Now what?
I would divide the second number.
By the second number. Which one? By this? By the third year. By this. Add that to 2 years. That's the payback. Yes.
I'm still doing the things. How can it be different, but I'm asking it all out. I'm still at it.
Let me just take a look. It's going to come out negative. It's not design FX in it. This one. Yep, it should be. Doesn't. It's not applicable. You won't get one. You won't get one like that. You won't get one where I give you a problem that's unanswerable.
One thing I didn't understand on the payback is how you got the 2.51 from the 0.51.
So you got 1 year, 2 years, and so now it's partway through the third year that it pays back.
Oh, I see.
So how part way? Well, 0.51 part way. And for HFT, if you set up the equations, it's going to be much the same. So minus 55,000, 35,000, 21,000, 7,500. You can see each one of these is set up the same way. What's the payback on this one? Now what? Yep. You're going to divide 20,000 by the 21. It's going to be 1.95. 1.95 years, correct. And if you look at it and you kind of think about it logically, you go, okay, payback. After 1 year, after 2 years, I'm at 56,000. It cost me 55,000, so it should be a little bit less than 2 years. 1.95 makes sense. So that gets you 16 points out of, in this case, out of 25. Now you've got, based upon your answers, if project BFT and project HFT are mutually exclusive, which projects do you select, if either, and why? So if they're mutually exclusive, what does that mean?
They don't. It's either this or that.
It's either or. You have to pick one or the other. So if they're mutually exclusive, which one do you pick?
Yeah,
Why?
because it has a higher.
As a higher net present value. Do not get trapped in this has a faster payback, so do this one. Remember, in finance, we go with net present value as our primary determinant as to which to choose. So if this says, okay, they're mutually exclusive, you can only pick one or the other, which one do I pick? I'm going to pick BFT. I'm going to pick BFT because the net present value is higher.
That's the foreign truck.
Yeah, that's a foreign truck.
Okay.
If project BFT and HFT are independent, which project do you select and why?
Both,
Both. Why?
because they're both above zero.
Because they both have a positive net present value. And both.
I was like, that's the easiest one.
The critical steps to success tomorrow morning is getting out your cell phones, take a picture of this. Get out your cell phone, take a picture of this.
Go back.
Take a picture of that. Recognize what you're going to be running into. The two problems that you saw tonight are very close, very different numbers, different company, but methodologically very similar to what you're going to see tomorrow. If you can get through, if you walk in tomorrow and you've got a relatively well set up template, or at least kind of know how to tackle this thing, you should be fine. Like I said, I got through the exam relatively quickly. A couple students who have taken it have gotten through the exam with time to spare, about 15 to 25 minutes. So you should be okay, but they were prepared coming in. If you're not, it's going to be tough. I'm going to tell you again, I can't stress enough, start with the multiple choice. You got 40 points of multiple choice. There's 20 multiple choice questions. About a third of them are true false. So if it's multiple choice with two choices. So if you don't know, you don't know. But they're true false. There's about a third of them. So just work your way through those multiple choices first. Try and do the best you can on those. That gets you 40 points. The other 60 points or 30 points apiece on each one of these, a weighted average cost of capital and a capital budgeting problem. If in doubt, and you need to kind of focus on something, focus on a weighted average cost of capital. Because if you can do this problem that we just walked through here, you can do the problem tomorrow, because I think the problem tomorrow is a little easier. Capital budgeting. Understand whether depreciation is a cash or non-cash expense. Which is it?
Not.
What does depreciation do for taxes? It's tax deductible, which creates what?
A tax shield.
A tax shield, which generates what?
Higher net.
Higher net income. Why?
Because you have less tax liability.
Less tax liability. If you look at, and I'm going to give one quick example, which will probably be useful. If you look at this negative 55,000, that's cash out in period 0, right? If you had depreciation and we said it's 10-year life, and you got $5,500 of depreciation each period for 10 periods, that's not cash expense. Your cash went all out the door in period 0 when you bought that piece of equipment. The depreciation expense of $5,500 is a reduction of your taxable income in each one of those periods, so it generates a tax shield. There's a cash inflow in each one of those periods associated with the tax shield. The cash inflow in those periods is equal to the depreciation amount times the tax rate. That's how much money comes back to you as like a tax refund associated with depreciation. Remember that. The depreciation percentage times the tax rate times your period zero expenses is your cash inflow in each of those periods. That's going to be useful depending on which exam version
Say
you
it one more
are.
time.
It's recorded. Yes, sir.
This might be a dumb question, but where is the weighted average cost of capital from?
Right there. It's the discount rate that you're using here, that you're using here. Gotta have a discount rate in there somewhere. You can see that it's here. There's E1. Other questions?
Can you go over?
Did I go over modified internal rate of return again? So modified internal rate of return. Delete. Formulas. If you're asked to calculate modified internal rate of return, go to your formulas tab and pull it up. Values. Values are going to be all four, in this case, all four values. The finance rate is not something you factor into here. You're going to use finance rate if you've got external financing associated with it. We don't have that here. All you've got here is the reinvest rate. Reinvest rate equals required rate of return.
Yeah, it was giving me all. Because I put, we don't.
Right. Yes, ma'am.
Could you go over payback for HF?
Payback for HFT again. Let's walk through payback. Payback. You've got your initial cash outflow. So I'm gonna link these together because it's just that much easier. So there's my initial cash outflow. Then I've got 35,000 coming in the next year. So I've got a plus 35,000. So my net out is equal to that plus that. So at the end of year one, I paid 55,000 out. I got 35,000 back, so I'm still out $20,000. So now we know it's taking over a year to get paid back. So then in year two, how much money came in? 21,000. I do that plus that. So now at the end of year two, we know that not only did we get all of our 55,000 back, because we had 20,000 out at the end of year one, and we got 21,000 in cash coming in at the beginning through year two. So we know that not only do we get all of our money back, but we got $1,000 more than that initial 55,000 by the end of year two. So you know your answer is going to be somewhere between 1 and 2. And so then the question is, what between 1 and 2? So you say, okay, I've got 20,000 was the amount that I was out at the beginning of the year. I got 21,000 during the course of the year. And I'm going to assume that that money came in even over the course of the year. So it took 95% of the year in order to be able to get that $20,000 that I was out. And then by the end, I had $1,000 left over. So my payback is 1 full year plus 95 hundredths of the second year. So 1.95. That makes sense?
Yeah, so you stop once you get.
Once you get to positive,
Okay.
you stop. And then you just kind of do this calculation here to figure out the partial year percentage and put that in there. Other questions? Okay, deep breath, get a good night's sleep, don't stay up all night. However, if you do want to, you can put yourself to sleep by watching this YouTube over and over and over again. It'll be up on my YouTube channel. Otherwise, I will see you tomorrow morning about 10:10 right here. You'll have 2 hours and then a little bit longer if no one follows in after the final. About 10 o'clock. 10:10, I think we're scheduled to start. But as soon as you get here, if the room's empty, you can start. Yes, ma'am.
You were saying something, can you help walk me through the appreciation thing?
Sure.
I don't understand what you're saying, so did I get this part right, that equation?
Thank you.
You're welcome. It's okay.
I got it.
Well, I got it. Okay, so let's assume.
Thank you.
Call it appreciation problem. Down from last year.
We can use a mowing one if you want.
Yeah, no. Like I got one from last year. I'll use last year's.
Good try.
We should have it now.
So let's assume that we've got, let's add in two things.
You have to do 2 fingers.
God bless you and your apple.
Either that.
God damn it.
2 fingers, yes. No. Ready?
Holy shit. Okay,
I have another here.
let's do
Oh, you're gonna hear during summer?
appreciation. Now let's do taxes. So let's say, for instance, this was one where it said, and we'll walk through this one. Packard just bought a new axle bender that's expected to save them $1.5 million. The machine was purchased for $1.5 million. It cost $50,000 to ship the machine and $150,000 to install it. So the total in this particular case is going to be, $1.5 million.
Feel free to join if you want.
You got $50,000 to ship it, and you got $150,000 to install it. So, oops, must have hit.
I think. Oh, there.
Oh crap! You and your apples. You got minus 1.7 million going out.
Okay.
It's a 4-year asset.
I followed
That's-
yours.
What is that? That's a maker's chart. We won't have that, right? It's so freaking confusing.
That's frightening.
It is scary.
So let's use the maker's chart.
Seriously?
Yep. So let's see. What do we got? We said it's going to save 1.5 million in operating costs each of the next 4 years. So there's 1.5 million, 1.5 million, 1.5 million, 1.5 million.
Yep.
I'm just not that bright.
I have one every day. No, it's still focusing capitalist.
So now we've got two things. We've got makers, 3 years, blah, 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 blah. Okay.
Will that show up if we have the depreciation version, the maker's table?
Yes.
And I have it all day tomorrow. All day. Bye,
So-
thank you.
Thank you.
Guys,
This says the machine falls in maker's 3-year class. So you know it's going to be it's in this column.
7.4.
Well, 3 years, year 1, year 2, year 3, year 4.
Oh, okay.
So
I
it's
see.
the maker's falls in the maker's 3-year class.
Okay.
So then we go, okay. Using the marginal tax rate from question 1, part 1, which is, nope, marginal tax rate.
Is that the 31.4?
Yep, 31.4%.
So marginal and effective is the same.
Not necessarily, but in this case it is. If not given, assume it's the same. What are the annual supplemental operating cash flows attributed to the machine for each of the next 4 years? So you know you've got 1.5 million in each of the next 4 years. And
Should
then,
this one be in terminal, do you think, or no?
yeah, it could be. So you go, okay, now I've got depreciation and taxes. So there's two ways to do this. You want to do it the easy way or the hard way?
The easy way, but would
Okay.
it be effective for tomorrow?
Yes.
Could I use it?
Yeah, either way is going to work.
Okay.
So what you're going to do is go, okay, my tax expense is going to equal to my operating cash flows times the tax rate. Oops.
Okay, so you did that times that number there.
Yep. So you're going, okay, I made 1.5 million that year, but I had to pay taxes on it. So all I did was go, how much do I have to pay in taxes? Well, 31.4% of my profit. So I made 1.5 million. I got to pay taxes on it. So that's what ends up as your net.
Okay.
That makes sense?
Mhm.
Okay.
Even in year 4, you have to? I guess as long as you have a positive number, right?
Right.
Okay.
I'm just trying to figure out where I've made a mistake. Okay. So then you go, okay, now I've got this depreciation bullshit to deal with. What do I do with depreciation? So the easy thing to do with depreciation is you go, it's a tax shield. So it's a positive cash flow. So you go, okay, it's going to be equal to my initial times year 1 is 0.3333 times.
Wait, I think you did
Oops.
that wrong, yeah.
Times tax rate. So here's why it's positive, because the initial is a negative cash flow.
Mhm.
So this is going to be money coming back in. So you got to make sure that that's positive. So
Even if it's negative, could you just take the absolute? Is it still going to be the right number just in negative form?
if it is, but you're doing it this way where you're summing these totals, it's going to be screwed up. So you got to make sure if it's positive cash flow, make sure it's a positive number. If you want to use an absolute value, if you want to multiply by -1, if you want to, but depreciation for capital budgeting is always a positive number.
Okay.
It's always a cash inflow. And so then the next period would be what? Why don't you walk me through it?
So I know that you have to times it by 40.4445.
And what am I multiplying that by?
The marginal tax rate and then the initial.
Now what do I need to do with it?
Times it by negative.
Sure.
That's what I'm saying. Can you just take the absolute value of that and so like basically making it positive, whatever
Yes.
value? Okay. So okay. So even if it's negative, the number will still be right. It
Yes.
just needs to be positive.
It needs to be
Okay.
positive.
Okay.
Next
so
one.
Then that one would be 0.1481 times the tax rate and then times that. And then, so for depreciation, is it only on incoming tax? Or wait, okay. Yeah, that would be incoming, right? Like operating, this is incoming because it's positive, right?
Mhm.
Yeah, so would you only depreciate what's incoming, like positive numbers?
Well, you're only depreciating you're depreciating your initial cash flow,
Oh.
right? Because so if you think about it, you bought a machine
Mhm.
and then you're going to depreciate it over 4 years.
Mhm.
So it's your initial cash flow. So I misunderstood your question. It's your initial cash flow is what your depreciation amount is on.
Okay. So you just depreciate it for the life of the machine.
Yeah,
Or
for whatever
life
it
of the
tells you.
whatever.
Yeah.
Oh, okay. So if, for instance, if this like had income for like, or if it was like a 6-year chart, but it said like use 3-year maker,
Mhm.
so you would only depreciate it for the first 3 years or 4 years,
Mhm.
and then after that, you
There's
would
no
have no
depreciation.
depreciation.
Right.
You just have income.
Right.
But it seems like this, I don't. Okay, you said it's a tax shield, which I guess I don't understand what that means, but it's bringing money in, the depreciation. Okay.
So here's
When I think of depreciation, I think of something bad because it's like losing value on your equipment, basically. Am I wrong? Because like when I think of
I'm
depreciation,
trying to think of how to explain it without sounding.
when
like
I think
an
of
accountant.
depreciation, I think of like driving a car off the lot and then
Mhm.
you lost like $5,000 right then.
Yeah, it's a little different. This is the accounting concept of depreciation. The accounting concept of depreciation is a little different. So if you got something for $1 million, accounting depreciation merely says, look, in year 0, you paid in cash $1 million, but you get to use that piece of equipment for multiple years. So you get to use it for 10 years. So accounting says, the $1 million you spent, you shouldn't expense that all in that year you bought it because you're going to use it for 10 more years. So what you should do is take $100,000 a year as the expense and allocate it. So you just spread the expense of the purchase out over the useful life.
So what it's doing here, I guess, is it's initially saying that you're losing $1,700 in total, but you're adding back these amounts, which over 4 years it will add up to that amount.
It'll add up to
the initial amount.
A little less. It'll add up to less than the initial amount because this is the amount of the tax savings. So is you're not going to get 1.7 million back. You're going to get equals $533,800.
That's how much that the depreciation should add up to?
Yeah.
Okay.
The depreciation should add up to your initial cash flow times the marginal tax rate. Essentially, that's how much taxes you'll save over the 4 years.
Okay.
You're still confused as all hell, aren't you?
No, like that makes sense, but what do you mean? How are you saving money over taxes, I guess?
So what this would be saying is your operating expenses or your operating revenue is 1.5 million, right? And you got to pay 471,000 in taxes on it. I'm trying
Is it like a write-off, you mean?
Kinda. I'm going to show it to you a little differently. Let's see if we can. Let me see.
Do you have somewhere to be? I know it's like past when.
8 o'clock is my next meeting.
Okay, sweet.
So, and this might prove useful. Okay. So I want to make sure you got it square. So the depreciation, let me just get this out here. Let's say the depreciation is 0.3333. You can see the total of these equals 1, right?
Okay.
So let's instead say we've got $1.5 million that we get in savings. And let's pretend like we're accountants.
Mhm.
So for accounting, we'd go, okay, we got 1.5 million in revenue, and our only expense is depreciation expense, right?
Mhm.
And so we go, okay, well, we're going to take that expense. So I'm going to take, this is going to be equal to minus that times that plus. It's in
What are you doing? What'd you just do?
So you see how the operating revenue now went down,
Mhm.
right? So my total cash flow is 640, 305, 54. Wait a second. Doesn't work here because this is a cash flow problem. What I'm trying to do is show the tax effect. So here it is. Here's what it would look like before the depreciation, right? So your tax, so you got 1.5 million in cash comes in,
Mhm.
and your taxes are 471,000 going out.
Okay.
If we add depreciation in, for taxes, we only have to pay taxes on 933,000.
Mhm.
Cash wise, we got 1.5 million
Okay.
because we got all the savings. We put the money out back here.
Yeah.
So cash wise, we oops.
So basically, you've got like 57,000 that you're not paying depreciation on for that year.
Yeah, you got. Your computer drives me nuts. I need to become Apple savvy.
Hey, it's the new upcoming stuff.
Yeah.
Next thing you know, they'll have Excel on Apple Watches.
Great. So I feel like I'm actually confusing myself more than I'm.
Okay, so basically, all I need to worry about right now is that this has to just be equals that times that times that.
Right.
Okay.
And it needs to be positive.
Positive. Okay, and then, so let's just do that right now, and then what do I do from there? Once I have that, like, so then once that's in there, what's listed as the total, would that be the net cash flow?
Mm-hmm.
Okay, at that point. But I don't get the depreciation problem. So that there then is your net cash flow.
Mm-hmm.
Okay. All right. All right. So then that's really all there is to it, right? Okay. But if it's given, are there going to be some that are given as like, this is the net cash flow? Or will we all have to, in some way or another, like solve this out?
All versions have some tax component on the
Is it going to be,
capital budgeting.
is it going to be like either taxes? So if, I guess my question is, if there's taxes, do you have to do depreciation? Or if there's depreciation, do you have to do taxes? Like, or do they go hand in hand? So if you're going to do them, do you have to do them both together? Or is there going to be like an instance where you're like only going to need to solve for taxes, or you're only going to need to solve for depreciation?
Yeah. There's no only depreciation.
Okay. Because the depreciation involves taxes.
Right.
But what about taxes?
There may be one with just taxes and no depreciation.
Okay. And then finding taxes is again just, is it just the marginal tax rate times the initial?
Yeah,
for
well,
the tax?
no, it's just a marginal tax rate as the taxes. Oh, are you talking for
To
the,
get that number, yeah.
this number?
Yeah.
No, take a look at where it's the operating cash flows, not the initial. It's the operating in each period,
Then how did it come out negative?
because it's an expense, right? You're paying the
Oh, did
IRS
you
money.
put it negative?
Yeah.
Because, okay. Oh, I see there. You put a little negative sign. Okay, sounds good. I guess I'm just gonna take my best shot.
That's it.
All right.
You'll be fine.
Let's see.
You put a lot of work in, you should be okay. But now, if I'm in your shoes, kind of knowing what I know today, I would focus on, and there's a couple examples both in the